This is the brief on Andrew Ross Sorkin's new book, 1929. Okay, so this isn't just some dry history lesson, you know? It's the really dramatic inside story of the stock market crash that kicked off the Great Depression. And it's told using details nobody's really seen before, like private letters and, get this, secret Federal Reserve meeting minutes. What the book finds kind of shifts our whole understanding of that time. First up, the author, Sorkin, he spent over 8 years digging into this, uncovering this really human drama. And he found that we've actually misunderstood a lot about that period. What's crucial is he got access, like the very first time anyone has, to the confidential board notes from the powerful New York Fed during those critical months in 1929. So what did that new access reveal? Well, second point, the crash was massively fueled by one guy, Charles Mitchell. He was the chairman and CEO of National City Bank. Think one of America's biggest investment banks back then. Mitchell totally changed Wall Street, pushing hard for debt-fueled speculation. He made it super easy for regular folks to buy stocks on margin. That just means borrowing money from the bank, often putting down as little as 10% cash. This risky stuff caused those margin loans to absolutely balloon, from around $1 billion earlier in the decade to nearly $6 billion. That's the bubble right there. And finally, the crisis itself was really defined by Mitchell just flat out defying the Federal Reserve. When the market plunged back in March 1929, Mitchell went rogue. He used his bank's own money to flood the system with loans, stabilizing the market single-handedly that day. Sure, he was hailed as an overnight hero, but his move completely undercut the Fed's power. It led powerful Senator Carter Glass to basically point the finger, calling Mitchell the man more responsible than all others together for the excesses that have resulted in this disaster. Ultimately, this incredibly detailed history shows us how one powerful man's overconfidence and his decision to just go it alone was the specific spark that turned all that wild speculation into a total financial catastrophe.
Software companies can fund their growth with accounts receivable factoring. Contact Chris at Versant Funding to learn if your software client is a factoring fit.
Okay, so today we're diving deep into the 1929 stock market crash. But not just the numbers, right? We're looking at it as this huge human drama, I think policy, big egos, and just a scary amount of, well, optimism.
Exactly. It's so much more than just Black Tuesday. Our sources really dig into the complex choices, the personalities, and these massive imbalances that were, building up for years.
Yeah.
It wasn't sudden, not really.
And that's our mission here, to shortcut you to understanding the why. Who were the key players? What was the culture like? Because, wow, stage was set. You had people making fortunes over $100 million. That's like $2 billion today.
Yeah, and executives pulling down salaries equivalent to, what, $37 to $56 million a year now? It's staggering.
And this is happening right alongside serious long-term economic pain, especially in rural America. So you've got this huge growing gap between the haves and have-nots. That's the backdrop.
A really volatile backdrop for the sort of financial frenzy we're about to get into.
All right, let's unpack that first big piece, this lure of easy money, and how debt just became normal, even fashionable.
Well, the Roaring Twenties, they weren't just about jazz and flappers. Financially, things got very loose. Borrowing just became a habit. Ordinary people got used to it.
Fueled by this, endless optimism.
Totally. This belief that prosperity would just keep going, so debts could be, rolled over endlessly into the future. There wasn't a sense of consequence yet.
Enter Charles Mitchell, chairman, CEO of National City Bank, the guy who really pushed borrowing for the stock market, right?
That's him. He wanted to sort of demystify banking. He famously said they sell our goods over the counter just the same way a clerk sells a necktie, make it seem everyday accessible.
Sounds good on the surface, like democratization. But it sounds like it opened the door to a ton of risk.
It absolutely did. Mitchell's bank aggressively pushed credit, making it way easier for regular folks to buy stocks on margin.
Okay, hang on. Margin. For anyone listening who hasn't dabbled, let's just nail that down. What was the real danger when borrowing got that high?
Right. So margin means you put down only a small fraction of the stock's price yourself, maybe just 10%, and you borrow the other 90% from your broker.
Okay.
Mitchell and banks like his helped blow up the total amount of these margin loans. It went from about $1 billion early in the decade to nearly $6 billion by 29.
Wow.
And the risk, it wasn't just losing your initial 10%. If the stock price dipped even a little bit, the broker could issue a margin call, meaning they could demand you repay that entire 90% loan immediately. Right now, if you couldn't, they'd sell your stock at a loss and you could still owe them money. It could wipe you out instantly.
But that risk didn't stop people, clearly. Even savvy people, like Groucho Marx. He was famously skeptical, wasn't he?
He was. And he owned RCA stock, which was selling for this crazy price, like $535 a share, and it had never even paid a dividend.
That makes no sense financially.
Right. Groucho questioned it. But his broker apparently convinced him. Said something like, Wall Street is no longer localized. It's going to keep going up and up and up. This idea that it was different this time, global, unstoppable.
And the broker's confidence just worked.
It quieted the skepticism, yeah, for a while.
But the ending wasn't funny for Groucho, was it?
No. Brutal. When the market eventually turned, Marx had to mortgage his house just to cover that margin call. He learned the hard way.
That confidence, it's like the whole system ran on it. Well, and when it vanished...
It vanished fast. You know that Hemingway line?
Yeah.
From the sun also rises. Someone asked how he went bankrupt.
Oh, yeah, 2 ways.
Gradually, then suddenly.
Yeah.
That captures it perfectly.
So while the average Joe, or even Groucho, was learning this lesson, the insiders, the Wall Street royalty, they weren't just using margin, they were like rigging the game.
Oh, yeah. Insider privilege was rampant.
And
blatant.
How blatant are we talking? Like the Thomas Lamont example, JP Morgan partner.
Yeah. Lamont arranged for friends of the firm, think former President Coolidge, Charles Lindbergh, to buy shares in a company called Allegheny.
Okay.
They got in at a secret discount price, $20 a share. The public price, $35.
Wow. Just like that.
It was pitched as an irresistible offer, built goodwill, locked in instant paper profits for the absolute insiders. That was just how things worked then.
And beyond those kinds of deals, they use these things called stock pools to basically pump up prices. That's something you don't hear about much now.
No, thankfully. A stock pool is basically a temporary club of rich investors who team up to manipulate a specific stock.
How'd they do it?
They'd pool their money, maybe millions, to buy up shares. Our sources mention one pool with W.C. Durant in it, putting over $12 million into RCA.
Okay, so they own a lot of stock. Then what?
Then they start painting the tape.
Which means faking trades, faking demand.
Exactly. They'd trade shares back and forth among themselves, sometimes using totally sham transactions, just to create this illusion of high volume and rising prices on the stock ticker tape.
To make it look like the stock was hot.
Precisely. Get the public excited, make them think they're missing out. Once enough ordinary investors jumped in, convinced it was going to the moon.
The pool dumps its shares.
Yep. They'd unload everything for huge profits. One pool apparently made nearly $5 million in a single week, leaving the public holding worthless stock as the price collapsed.
Incredible. That level of manipulation,
Yeah.
It had to lead to conflict with Washington, right?
Yeah.
With the regulator.
It did. This brings us to a major clash. Wall Street versus the Federal Reserve.
Where did that really kick off?
It starts heating up in February 1929. The Fed board in Washington sees this crazy speculation, this bubble, and they get worried, so they issue an advisory.
Telling banks what?
Basically, discouraging them from making loans for stock speculation, especially these margin loans.
And Charles Mitchell, Mr. Margin Loan himself.
He was reportedly shocked and upset. This directly threatened his bank's biggest business.
So tensions are high. Then what happens?
Fast forward to March 26, 1929. The market suddenly takes a dive. It looks like panic might set in. Mitchell realizes the Fed isn't going to step in and provide liquidity, provide loans to stabilize things.
So he takes matters into his own hands.
He does, unilaterally. He announces that his bank, National City, will pump $25 million into the loan market. A huge sum then.
What was the effect?
It worked. Instantly, it reversed the panic. Mitchell became this overnight hero on Wall Street. People saw him as the new J. Pierpont Morgan, the legendary banker who'd saved the market in past crises.
A hero to Wall Street, maybe? But fundamentally, wasn't that incredibly irresponsible? He basically told the Federal Reserve, I'm in charge, not you, undermining their policy for his bank's benefit.
No, the Federal Reserve Board was absolutely apoplectic, furious. They saw it exactly like that, a direct hostile challenge to their authority, an attempt to undermine their control over money purely to boost his own bank's selfish prestige, as they put it. He defied the central bank openly.
That kind of defiance must have had political fallout.
Huge fallout. It brings Senator Carter Glass into the picture. Powerful Democrat, very anti-Wall Street, and a key architect of the Federal Reserve System itself. He deeply believed in its integrity.
And he saw Mitchell as...
As the villain, Glass was convinced the eventual crash was, in his words, just the result of Mitchellism. He later said Mitchell was more responsible than all others together for the excesses. Glass became Mitchell's political nemesis.
Okay, so that's the political angle. What about the big speculators? Were they worried?
Some were. W.C. Durant, the GM co-founder, big-time speculator, stock pool guy, he was actually terrified, but not of the speculation itself.
What was he scared of?
He was scared the Fed would cause a crash by being too tight with credit. He thought they were ignorant of how markets really work.
So he wanted more easy credit.
Yes. He actually tried to get a secret meeting with the new president, Herbert Hoover, right after the inauguration in March 29.
To plead his case.
Yeah, to basically beg Hoover to tell the Fed to loosen up, to reverse their clampdown on credit. Durant argued the whole economy depended on that credit flow.
Did Hoover listen?
Hoover remained skeptical. He kind of thought stock prices were inflated and needed to come down naturally. He didn't intervene.
So heading into the fall of 29, you've got these wildly different views, warnings and reassurances.
Total schizophrenia in the market outlook. You had Roger Babson, a market analyst, warning in September that the boom would collapse like the Florida land boom had a few years earlier. His warning actually caused a temporary dip, the Babson break.
But the establishment view is different.
Oh, yeah. You had Irving Fisher, a very respected Yale economist, famously declaring that stock prices had reached a permanently high plateau. He even argued they were still undervalued.
And Mitchell, the bankers.
They publicly agreed with Fisher. The overwhelming consensus among the financial elite was still incredibly optimistic, right up to the edge.
Which brings us to Black Thursday, October 24th. The optimism finally breaks.
It shatters. The scene was apparently pure chaos. $1 billion lost in just the last hour of trading. The stock tickers, the machines printing prices, they just couldn't keep up. They were running hours behind. Nobody knew what prices really were.
Panic. So did the bankers try another rescue, like Mitchell's in March?
They tried. The Big Six bankers, led by Thomas Lamont from Morgan, got together. They pledged $40 million each, a lot of money to support the market, to fill the air pockets by actively bidding up key stocks.
Was there a public display?
Yes, very deliberate. Richard Whitney, the vice president of the New York Stock Exchange, very visibly walked onto the trading floor and placed a bid for U.S. Steel at $205 a share, well above the current collapsing price. It was pure theater, designed to project confidence.
Did it work this time?
Temporarily. It stemmed the bleeding for a day or two, but the underlying selling pressure was just too immense.
Loading to Black Tuesday, October 29th. The real wipeout.
That was the day the floor truly dropped out. And the image that sticks with me from our sources. That night, October 29th, Charles Mitchell attended a formal dinner party.
Seriously? While the market was imploding?
Yes. A dinner for Winston Churchill, no less, hosted by the financier Bernard Baruch. Mitchell knew his own bank, National City, was in deep trouble. It had bought too much of its own stock trying to prop up the price and was facing an existential crisis.
What did he do at the dinner?
He tried to keep up appearances, but there's this incredible detail. At some point, he reportedly raised his glass and toasted the room.
What did he say?
To my fellow former millionaire.
Oh, my God. The gallows humor, while probably knowing his own fortune was evaporating.
Exactly. And imagine the tension. Mitchell making this dark joke, knowing his world is crumbling, and sitting right there is Winston Churchill.
The guest of honor.
Who himself had been speculating heavily on margin. He was apparently nursing a massive personal loss, something like a $75,000 hole in his trading account, which was a fortune then.
That dinner party. It's like the perfect, tragic snapshot of the end of the era, isn't it? The Roaring '20s just ended right there in that room.
It really feels like it. And immediately after the crash, the focus shifted from speculation to blame.
Yeah.
And Mitchell became the #1 target.
The scapegoat for the whole decade's excess?
Pretty much. They went after him hard, specifically for tax evasion.
What was the charge?
It related to a sale of National City stock he made near the end of 1929. He sold a huge block to his wife, Elizabeth, at a massive loss.
To offset his income for tax purposes.
Precisely. The transaction was documented with these now infamous Dear Charles and Dear Elizabeth letters, formally recording the sale. He claimed a $2.8 million loss to reduce his tax bill.
How did that come out?
Through the Pecora hearings. These were Senate Banking Committee hearings starting in 1933, led by Ferdinand Pecora. They called him the hellhound of Wall Street.
Sounds intimidating.
He was. The hearings were designed to expose Wall Street's culture, its practices, its massive compensation packages. Mitchell's tax deal became Exhibit A.
Did Mitchell defend himself?
He did. He insisted the sale was legal, that it was a legitimate transaction, and pointed out that he, personally, had lost more money on National City stock than anyone else.
And the outcome of the trial?
He was actually acquitted of the tax evasion charge.
Acquitted, so it was legal.
And that was the real bombshell. The fact that this practice, selling assets to your spouse at a loss to claim a tax deduction while looking incredibly shady, was technically legal at the time. That and other practices revealed showed the system itself was broken. It allowed, even encouraged, deeply unethical behavior.
So the acquittal almost proved the need for reform more than a conviction would have.
Exactly. It showed Congress that the laws themselves needed changing. Urgently.
Which brings us to the legacy. Culturally, what changed?
Well, you have these powerful symbols, like the Empire State Building. John Raskob, another tycoon deeply involved in the speculation, financed it. It opened in 1931.
World's tallest building, a monument to that same optimism, right?
Precisely. But it opened into the teeth of the Depression. It couldn't find tenants, and it quickly got this bitter nickname.
The Empty State Building.
Yeah. Perfectly symbolizing how that soaring optimism had just evaporated, leaving this hollow monument.
And on the regulatory side, the Pecora hearings really forced action.
Absolutely. The revelations were just too damning. And then there was a surprise move. Winthrop Aldrich, the head of Chase Bank, a major competitor to Mitchell's National City, unexpectedly came out in support of separating investment banking, the risky stock underwriting and trading, from commercial banking, regular deposits and loans.
Why was that significant?
Because it broke the Wall Street ranks. It gave Senator Glass, Mitchell's old foe, the political cover and momentum he needed. He'd wanted to force that separation for years.
So Aldrich's move helped Glass push through his big reform bill.
It was crucial. The result was landmark legislation, the Glass-Steagall Act, which mandated that separation between investment and commercial banking for decades.
And the SEC.
And the creation of the Securities and Exchange Commission, the SEC, a federal watchdog specifically designed to police the markets, prevent insider manipulation like stock pools, and regulate things like margin trading. Basically, to stop the Mitchell-era abuses from happening again.
Looking back, what's the sort of enduring lesson from it all?
Well, one interesting point from the sources is that the crash itself didn't immediately cause a mass revolution or a huge spike in suicides. The national suicide rate actually dipped slightly that fall, strangely enough.
Really?
Yeah. But what it did lead to was the longest, deepest economic depression in American history. It revealed that Wall Street just didn't have the kind of control, the superpower it thought it had, to just fix things.
And it shattered trust, didn't it?
Completely. The fundamental question left hanging was, who can you possibly trust? Your broker, the bankers, the experts, the government.
And the sources suggest the answer isn't just more rules.
Not just rules, no, or even just skepticism. They argue the real antidote to that kind of irrational exuberance is humility.
Humility.
Yeah. The humility to accept that no system is perfect, no market is totally rational, and honestly, no generation is immune. We can all get caught up.
It really does come back to the human element, doesn't it? The ego's Mitchell, Durant, the collective psychology, this willingness to just ignore risk for quick gains.
It was, as one source put it, a race between education and catastrophe. And in 1929, catastrophe clearly won.
It's interesting, too, how the culture back then wanted heroes. They preferred celebrating guys like Admiral Byrd flying to the South Pole rather than focusing on the financial mess.
That desire to look away from failure, to focus on triumphs, maybe that's the most human part of the whole story. It's relatable, even now.
Which leads us to that final thought for you, the listener, thinking about that tendency. What is our culture celebrating today? What forms of maybe unquestioned growth or what irresistible offers might be blinding us to risks building up underneath? What current systems or products feel so solid right now that questioning them feels like you're just, fighting the inevitable trend? Something to think about.
Factoring can meet the cash needs of energy companies looking to expand. Contact Chris at Versant Funding to learn if your energy client is a factoring fit.
Welcome to The Debate. Today, we're digging back into that really quite extraordinary period leading up to the 1929 stock market crash. We're specifically looking at the dynamic between the newly established Federal Reserve and the very powerful, entrenched leadership on Wall Street.
Right.
And the core issue for us, the central question, is really about the severity of the crash. was its devastating impact, primarily down to the Federal Reserve's, let's say, misguided attempts to centrally curb speculation? Or was it more caused by powerful individual Wall Street figures who actively, undermined regulatory efforts for their own huge personal and institutional gain? My position is that the severity was primarily driven by these powerful individual bankers whose calculated self-interest actively defied and frankly destabilized any attempts at orderly restraint.
And I'm coming at this from a slightly different angle. I mean, while the ambition, the drive on Wall Street was, well, undeniable, I'd argue that the catastrophic severity of '29 actually stemmed primarily from the systemic failure of the Federal Reserve itself. Their attempts at centralized intervention were, I think the evidence shows, ill-informed, often politically compromised, and they ultimately created the very panic they were trying to prevent. When you look closely at the source material, the failure feels structural, which then, necessitated the stabilizing actions later taken by individuals, however ambitious those individuals might have been personally.
Well, the source material, I think, pretty clearly points to Charles Mitchell, the chairman and CEO of National City Bank, as really the central figure driving instability. Mitchell essentially operated as the, quote, red-hot engine of the new Wall Street. He actively fueled the speculative boom by dramatically expanding access to margin credit through his bank's subsidiary, National City Company. And just to put this in perspective, under his watch, these loans ballooned from about $1 billion to nearly $6 billion. He managed this by basically turning stock ownership into a kind of consumer product, making it accessible to the, quote, everyman using borrowed money, that margin credit.
Right.
Now, the dangerous complexity here, the real rub, is that Mitchell held a seat on the Federal Reserve Bank of New York board while he was orchestrating this massive expansion. And Federal Reserve Governor Strong had actually worried about this exact conflict of interest. He noted that Mitchell had an exceedingly active and well-developed ego and would likely use his confidential knowledge of the Fed's plans for his own bank's advantage. And this conflict really came to a head in March 1929, when Mitchell deliberately chose to defy the Federal Reserve Board's stated policy of credit restraint by injecting millions into the call money market. His actions directly led Senator Glass to later brand him, pretty bluntly, the chief offender for the whole disaster.
Okay. While I absolutely recognize the weight of that evidence regarding Mitchell's self-interest, I think framing it solely around him fundamentally misreads the systemic pressures that were really at play. The Fed, particularly the board back in Washington, seems to have been acting from a position of, profound ignorance about how the markets actually worked. And this wasn't just my view looking back. Powerful figures at the time, like Mitchell himself and the big speculator William Durant, they held this view pretty strongly. If we look at the actual timeline, the crisis wasn't simply catalyzed by Mitchell's credit expansion alone, though that was certainly part of the backdrop. It was the Fed's own, frankly, clumsy, centralized intervention that acted as the immediate trigger. Their anti-speculation advisories, issued in early February 1929, these formal statements basically scolding the public and the banks, they were instant destabilizers. These pronouncements triggered a sharp 4% drop in the Dow and crucially caused call money rates to just soar.
Right, the call money rates.
Exactly. To clarify for listeners, call money rates are what brokers pay banks to borrow money for those margin loans, and normally they're pretty low, maybe 6–8%. But when the credit market paralyzed on March 26th, those rates skyrocketed, briefly hitting 20%. That meant the entire credit structure was just seizing up. So Mitchell's emergency lending of $20 million that day, I argue it wasn't reckless defiance in that moment. It was actually a necessary response to prevent the entire market from completely freezing solid. Durant might have been right when he argued the resulting panic was, quote, authorized, approved, and caused by the Federal Reserve Board, simply because their stern warnings hadn't been backed up by, effective policy tools. And later analysis actually confirmed that Mitchell's action did relieve the money market and stabilize the rates, bringing them down from 20% to 9%, which kind of proves his intervention was essential stabilization, at least in the very short term.
But you characterize Mitchell's emergency action as market stabilization.
Yet he was, first and foremost, the primary generator of the initial instability that made such a crisis possible. That institutional commitment within National City to reckless expansion and, crucially, fees, it consistently overruled investor safety. We really have to look closer at the institutional rot within National City, driven directly by Mitchell.
Okay.
Red-hot engine. And this was driven by fees, not by prudence. I mean, consider his push to promote those high-risk foreign bonds, specifically the ones from Minas Gerais in Brazil. The bank pushed these products despite having internal warnings about the, quote, inefficiency and ineptitude of the officials involved. This is key. They knew the risk was high, but the underwriting fees were just too lucrative to pass up. They prioritized short-term institutional profit, those fees earned from selling these risky foreign instruments, over the long-term safety of the system and, frankly, their own investors. It wasn't just a regulatory vacuum, it was an active institutional choice by banking leadership to aggressively amplify global risk for profit.
That institutional commitment you describe is clear, yes, but doesn't the context of the era itself suggest that this was simply, perhaps, a rational response to an environment where the central authority, the government, was intentionally hobbled? I mean, President Calvin Coolidge's administration was dedicated to an extreme form of laissez-faire capitalism. The Federal Reserve, as the material itself explains, was an imperfect institution, limited in power and scope. It just lacked the political muscle and arguably even the clear legal mandate to impose effective control over Wall Street in the Roaring '20s.
But does that excuse the actions?
Well, the issue then isn't just Mitchell's ambition, though it was certainly there. The issue is the systemic failure of the central authority to establish legitimate, respected control. The Fed was, it seems, structurally ill-equipped to handle the unprecedented scale of capital that was flooding in, seeking those high yields. Mitchell's bank, in a way, filled the vacuum left by a politically weak and often demonstrably ineffective central bank. So if the structure of regulation is fundamentally flawed, then holding one individual primarily responsible for acting however aggressively within that flawed system, well, it kind of misses the bigger picture of institutional incompetence right at the top. And let's focus specifically on the functional result of that direct conflict in March 1929. Mitchell and Durant, they were critics who argued, and arguably correctly, that the Fed's high interest rate policy would hinder genuine economic growth, not just speculation. So, when the Fed failed to act decisively to stem the panic caused by its own clumsy advisories, Mitchell stepped in. His $20 million intervention, whatever the motive, immediately settled the market. So why should we focus solely on the motive, the desire for, quote, selfish prestige, when the functional result was averting a potentially catastrophic credit seizure right then and there? The market desperately needed liquidity, and it was a private entity, not the central bank, that stepped up when the Fed hesitated.
See, I'm just not convinced by that line of reasoning because the aftermath, I think, showed that Mitchell's self-interest was precisely the problem regardless of whatever temporary relief he provided. Adolph C. Miller, who was a Federal Reserve Board member at the time, pointed out the critical consequence here. Mitchell's very public interview where he revealed his massive gambit, it actually, quote, overthrew banking control of the situation and started up speculative activity anew.
Okay.
Yes, the immediate panic subsided for a bit. But the reckless speculative frenzy, the very thing the Fed was trying desperately, however clumsily, to eliminate was consciously restarted by Mitchell. He didn't stabilize the market to foster orderly credit. He stabilized it just long enough to allow the boom to continue so his bank could profit further. His intervention acted like a defibrillator, sure, bringing the patient back to life, but only to encourage him to immediately sprint into another high-risk marathon. And this, I think, confirms Governor Strong's earlier reservation perfectly, that Mitchell would use his confidential knowledge for the advantage of his own bank, directly undermining the Fed's attempts at restraint. And the consequences of these independent profit-driven actions, they demonstrate just how fundamentally corrupted the system was by individuals at the top, The Pecora hearings later really laid this bare. When you look at the evidence presented there, it goes way beyond mere ambition or policy disagreements. Mitchell himself faced an investigation for those highly questionable tax-evading stock sales, selling 18,300 shares of National City stock to his own wife in 1929, specifically to claim a staggering $2.8 million loss on his taxes.
Right. The tax issues were significant.
Absolutely. And the revelations during the Pecora hearings detailed widespread insider dealings, the use of stock pools, like that infamous one Durant was involved in with RCA stock, netting the group nearly $5 million, and just a general, profound lack of accountability. I mean, these aren't minor quibbles over monetary policy. This is evidence of systematic fraud and corruption driven by individual actors who clearly believed they were immune to the rules. The entire collapse was, as Senator Carter Glass memorably put it, just the result of Mitchellism.
That's a very compelling argument regarding the corruption. And look, no one disputes the extent of the insider dealing that the Pecora investigations revealed. It was shocking. However, have you considered that focusing so intensely on Mitchell's moral failures and the insider pools might actually be a bit of a distraction from the broader source of instability that ultimately overwhelmed the entire system?
How so?
Well, Durant warned Hoover, didn't he, that the Fed's high interest rate clampdown was stifling genuine prosperity, not just speculation. But maybe more importantly, the source of speculative money was far, far broader than just Mitchell's bank or even all the banks combined. Even after that initial March scare and the more significant Babson break in September 1929, the market resumed its advance, and it was driven by a mass explosion of brokers' loans coming from corporations and foreign companies.
Okay.
This is a key technical point, I think. The Fed's traditional tool for tightening credit was basically to restrict bank lending. But when major U.S. corporations were suddenly seeing they could get 20% interest yields on money lent directly to brokers for margin loans, well, they poured billions into the market, something like $8.5 billion that year alone, completely bypassing the regulated banking system. This huge surge of non-bank capital essentially neutralized the Fed's primary policy mechanism. The speculative fire, you see, was being fed not just by individual bankers like Mitchell, but by global capital flows attracted by these unprecedented high U.S. yields. It suggests the central authority was maybe structurally incapable of managing the situation, regardless of whether Charles Mitchell was corrupt or not.
Definitely presented challenges to the Fed's traditional tools, no question. But the central argument, for me, remains. The severity of the crisis was profoundly deepened by the actions of those individuals who had a fiduciary duty and indeed the power to act more responsibly. Mitchell, especially as a Fed board member, was one of the few figures potentially capable of exercising some orderly restraint. Instead, he chose calculated, very public defiance, primarily to protect his own institutional fees and prestige, and in doing so, he amplified the very conditions that allowed those non-bank corporate loans to flood the market. The greed, the choices of key individuals, I believe, exacerbated the crisis and guaranteed its devastating depth.
And I would reiterate that the Federal Reserve's structural weaknesses, combined with its political fragility and its clear propensity for poorly timed, even panic-inducing advisories, meant that responsibility for the devastating severity of 1929 must be weighted very heavily toward the systemic failure of the central banking system itself. They simply lacked the capacity, perhaps the legal mandate, or maybe just the respect needed to effectively manage the incredible complexities of that new economic era.
It is certainly a crucial tension, isn't it, between that centralized authority trying to find its footing and the sheer force of market freedom, or perhaps license, that defined the era, and one that, as the material shows, was perhaps resolved, tragically, by disastrous individual action.
Yes, the material definitely offers strong evidence supporting both views, compelling us, I think, to really consider whether it was the individual actor or the flawed systemic structure that ultimately bore the greater responsibility for the catastrophe that followed.
Food processing companies can fund their growth using the cash accounts receivable factoring can provide. Contact Chris at Versant Funding to learn if your client is a factoring fit. Factoring can meet the cash needs of staffing companies looking to expand. Contact Chris at Versant Funding to learn if your staffing client is a factoring fit. Food processing companies can fund their growth using the cash accounts receivable factoring can provide. Contact Chris at Versant Funding to learn if your client is a factoring fit. Factoring can meet the cash needs of staffing companies looking to expand. Contact Chris at Versant Funding to learn if your staffing client is a factoring fit.